Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome. Today's topic for lecture is real estate market cycles as part of the course Real Estate Finance and Investment Strategies. Let's first discuss the learning objectives for today's class. The fundamental characteristics of real estate market cycles, the 4 phases of real estate cycles and their distinct features, key leading indicators that signal market transitions, how different property types respond to market cycles, strategic implications for investment decision making, and then risk management approaches across cycle phases. So, why do real estate cycle exist? So, unique characteristics creating cyclical behavior. We have super inelasticity that cannot quickly adjust to demand changes, that is your supply inelasticity. So, when demand for Apple shares increases, Apple can issue more shares relatively quickly, but when demand for office spaces in Bengaluru increases, we can't simply create more buildings overnight. So, real estate supply is inherently rigid and slow to respond. So, you will see that there is a delay or there is a gap in between when the demand actually comes up and the supply there to cater to that. So, for example, in 2019 there was a boom in commercial real estate, specifically in those cities where IT sector has a major presence. So, Bengaluru, Hyderabad. So, that time that was the very boom period, and by the time supply started coming in and there was already lot of appreciation in prices, and by the time the supply came in, actually there was a COVID period, and so after that we all know that it was negative for the commercial office buildings because of the the work from home culture which started, and because there were many social distancing norms that was followed at that time. So, you can say that the supply that was extreme situation, but you can understand that these type of gap between when the requirement actually is and when the supply is coming. So, there is a mismatch because of the kind of time it takes for construction project to complete. So, it's not that quick like the way you can expect that in stock market. Then we have long development times. We can understand that once the requirement has come, the supply will take time. So, 24 to 36 months from planning to delivery. So, it will be long period for that. So, from the moment a developer identifies market demand to where they can deliver completed space, we are looking at 24 to 36 months minimum. This include land acquisition, approval, construction and final delivery. So, during this period market condition can change dramatically, like the example I gave you. And then we have high capital requirements can create another barrier. Basically, real estate development requires massive upfront investment. There is land cost, construction financing, regulatory approvals. This isn't like manufacturing where you can quickly scale production up or down. And then we have durability. So, durability of real estate means building construction today will influence market dynamics for decades. So, a commercial building typically has 50 years lifespan, meaning today's supply decision impact multiple future cycle. And then we understand that market, these properties are not homogeneous, they are very heterogeneous. Every property is unique. So that also plays a crucial role, and that prevent market efficiency, perfect market efficiency. So one example, when IT employment surged in Bengaluru in 2021 to 2022, office demand increased immediately, but new supply took 2 to 3 years to respond. So that situation just after COVID and before COVID. So these kind of situations can be there, that periods of expansion, periods of supply coming, and then there is no requirement, though no supply available. So these kind of situations can take place. Then we have real estate cycles versus other asset classes. So we see that this basically table telling us that how they are different. So real estate cycle duration will be 7 to 10 years. Stocks, it will be 3 to 5 years. Price adjustment speed in real estate will be slow, while in stocks and bonds it can be very, very fast. Then supply response in real estate can be delayed. It can be 2 to 3 years. And in stocks and bonds it can be immediate. Transaction cost, real estate, is very high because of the the stamp duty, registration charges, all that. And stocks, you will see that transaction cost is low. Then you have market transparency in real estate, which is limited. There is not any specific market or which can tell us about the actual price situation. People are dealing with each other, and so all that is not there. But in stock we have proper primary market, we have secondary markets which are there. So proper price discovery takes place and it is very transparent. Then we have historical cycle, we have seen previously also. So just to quickly understand, so post liberalization there was gradual growth. Then 2003 to 2008 there was rapid expansion and peak. 2008 to 2010 there was global financial crisis. So that was the impact. 2010 to 2016 a recovery and moderation expansion took place, and 2016 to 2020 structural adjustment period. We understand that lot of new rules came in, whether RERA, GST, or before that the REIT also came in. So it has been a structural adjustment period, and 20 to 21 was a pandemic induced contraction, and 21 to 25 there was strong recovery and expansion. So these are some important things which have happened in past few years in Indian real estate. So key learning here is that each cycle has distinct characteristics influenced by economic, regulatory and structural factors. So we come to the 4 quadrant cycle framework. So this framework is the analytical foundation for understanding real estate cycle. Think of it as a compass that helps you navigate market condition. So the primary driver is the relationship between supply and demand. When demand exceeds supply, we move up the cycle. When supply exceeds demand, we move down. The key metric to watch is occupancy rates and vacancy trends. These are the most direct indicators of supply demand, right? Supply demand balance. And then we have phase duration. Typical ranges from 18 to 36 months per phase, though this can vary significantly based on market conditions and external factors. So you will notice how the phases flow logically from one to another. You have recovery leads to expansion, which creates condition to hyper supply and eventually resulting in recession. So which sets up the next recovery. So this basically is how the market cycle will takes place. Then we come to recovery phase characteristics. So market conditions, we have high vacancy rate beginning to decline, right. So, these are the conditions which we can see in phase 1 where market bottom to. So, during recovery are characteristics by high vacancy rate that are finally beginning to decline. This is the key signal, not just high vacancy, but inflection point where vacancy stop rising and start falling. Construction activity is minimal because developers are still scarred from the previous downturn. Financing is difficult to obtain and market sentiment remains cautious. Rents are at cyclical low with limited growth. Property values are stabilizing after significant decline. This creates the investment opportunity. So, basically a gradual pickup is taking place during the recovery phase. There are things which are stabilizing but have not stabilized, but slowly and gradually things are now moving in the right direction. Then we have investment opportunities during the this period. So, we have investment opportunities during recovery are some of the best in the entire cycle. You can acquire distressed assets at below replacement cost. We have value add strategies through repositioning that can generate substantial returns, and strategic land acquisition for future developments can be incredibly profitable. These are some things which you can see that when you actually can look at a office market, Bengaluru office market, where you can see that vacancy at 15% began declining, and as IT companies resume expansion plan. So, you can see in this type of phase is the best time for investment. The stabilizing is still going on, it's a ongoing process, and you can basically go for the buying of property at the below replacement cost. So, these type of situations can be very advantageous. So, a right time for investment in this period. Again, I will emphasize this property values are stabilizing after decline, things are about to settle, about to improve, and then you are trying to acquire distressed assets at below replacement cost. So, this can be the best period which you can see for the investment. Then we have expansion phase, which is your vacancy rates falling below equilibrium, accelerating rent growth at 8 to 15% annually, construction activities increasing but lagging demand, property values rising due to NOI growth and cap rate compression. We have development projects becoming financially viable, aggressive leasing strategies, strategic refinancings to extract equity. So, this is your expansion phase. So, let us take this one by one. So, we are talking about vacancy rates falling below equilibrium, right? It is falling below equilibrium, and accelerating rent growth. We are seeing that rent is increasing, right? And construction activities have started increasing, but lagging the demand. So, demand has picked up, construction activity is still picking up, and the property values are rising due to NOI growth and cap rate compression. So, basically you have started realizing that market is moving in the positive direction now, and you can see that the demand is there and the supply is still not reached. So, kind of now clear it is that things are in the upward direction. They were not that clear during the recovery phase, but now they are much more clear. There is a sustained growth and things are moving up. So, what about the investment opportunity? So, development projects become financially viable. If there is an existing project, it becomes very useful because there is a demand, and if you had already started your project, it is in high demand, and people are now thinking of actually investing into newer properties. So, basically a good time for project to end and become part of the supply. And aggressive leasing strategies are being adopted during this period because people know that soon there will not be much supply available. So, aggressive leasing strategies will be there. It will be a seller's market, and strategic refinancing to extract equity. And so, development projects also, they can go for these refinancing to extract the best outcome. So, this kind of expansion phase will be there. So, Mumbai residential market, sales volume increased by 70%, price rose by 15 to 20% across micro market. So, this period saw in Mumbai residential market that sale volume increased by 70% and price rose by 15 to 20% across micro markets when people realize that it is a expansionary sustainable growth period. Then we have hyper supply phase. Here you see, after they have realized that the things have started in the positive side and there was a huge demand for So, of course, people started their projects and multiple people started the project, and because of that in few years there was hyper supply which came in, and because of this hyper supply, new completion exceeds the net absorption. Now the demand is not meeting the kind of supply there is, and so vacancy rates are rising and rent growth is slowing or turning negative, and construction pipelines still high due to development lag. So, there is still some construction going on, and so basically all this is there, that supply has now increased to a certain to a specific level where the demand is not meeting it, and the investment will be challenging, of course. Increasing competition from new properties, pressure to maintain occupancy through concessions. So, you might be giving concessions to your tenants because now they have option of multiple supplies. So, you will have to retain them, you will have to give them concession, and then refinancing will become more difficult now because financer also have multiple options. So, basically now it is no more a suppliers market, it is basically now again turning into a buyer market. So, this is how the hyper supply phase will work. And then we have recession phase, which is your market and economic contraction. So, sharply rising vacancy rate rising, occupancy rate declining, then negative rent growth with increased concessions. So, you have negative rent during this period, rents are going down instead of going up because you have started giving concessions to tenants to somehow keep them with you. Then minimal new construction will start, nobody will try to venture into such a market. So, there is a no new construction happening, property values are declining significantly, and distress sale beginning to occur, especially for those who are on leverage. They will try to recoup whatever investment they have done, so that they can close their leverage positions. And then we have capital preservation strategies which can be done at this time. Selective opportunistic acquisition for those who are prudent enough to wait for these times. They will start nibbling in these markets selectively. And then tenant retention prioritized over rent optimization. So, the idea will be to somehow keep tenants so that these times can be just sailed over, and after these times get past, we will have better times. So, just the retention will be prioritized over rent optimization right now. So, these kind of phase will be dealt like this. So, especially this happened in Indian hospitality sector during COVID times. So, occupancy fell to 30 to 35%. So, these kind of fall in the occupancy was visible at that time. So, phase transitioning timing, you see recovery of 18 to 24 months, then expansion of 24 to 36 months, and then hyper supply of 12 to 24 months, and then recession of 12 to 18 months. So, this is how the cycle will actually go like. And the supply constraints and regulatory factors environment, that is the factor which is affect the duration. What is the regulators role in this, what regulatory changes they take at these times play a crucial role. Supply constraints also, how they are there, and then economic growth stability, these are also playing along with the economic growth of the country. So, if economic growth stability, how in what time it is achieved, and then external shocks. So, policy changes, global events can also play a crucial role, and then market majority and institutional participation will have role in this. And then these are the things which will dictate the time period for phase, each phase, how much longer it will be there. Then importance of leading indicators, which tells us that what is about to come. So, for example, strategic, what are the strategic advantages of these early detection matters. Now, we have optimize acquisition and disposition timing. So, basically, if we are aware of these cycles, we know how to play them, then we can optimize the acquisition, and position timing can also be decided. Adjust the development pipelines proactively. So, we will adjust the development pipeline as per the upcoming period. So, we will plan accordingly, and then implement defensive measures before downturn. We can implement these defensive measures because we know what is about to come, and position for recovery opportunities ahead of competition. So, we can then position for recovery opportunities ahead of the competition. So, this way if we can early detect, then we can plan accordingly. So, typical lead time leading indicators provide 6 to 24 months advance warning of the cycle transition. But how to read these signs is something which not everyone can do. This has to be dependent on one person to another person. Also, you might not be exactly right with the timing, but generally if you can favorably predict the overall direction, that may be well suited for you. Then we have challenges. So, distinguish between the temporary fluctuation and genuine cycle transition. So, sometimes you will see that there will be sudden uptake in the from the recession. So, you might think that recovery period has started, but it might not be recovery period. It is just a a small blip in the overall scheme of things, and the things will go back to recessionary phase. So, these things can also happen. So, it is not just a simple simple formula which you can use. It's more like with years of experience and intuitiveness that you can have these early detection signs. Then we have macroeconomic leading indicators, which can show some of the changes which might be taking place. For example, GDP growth rate. So, these are broad economic signals we are talking about. So, GDP growth rate. So, 7% generally supports expansion phase, 5 to 7 moderate growth, and less than 5% often associated with market slowdown. So, we are talking about India here. So, these are the kind of growth rates of GDP which are telling us that greater than 7 generally support expansion phase, 5 to 7% is your moderate growth, and less than 5% can be alarming and often associated with market slowdown. Then we have employment growth. So, ITS employment directly drives office demand, especially we have seen in sectors like Bengaluru, where they are directly impacting the office demand. Then every 100,000 new IT jobs is equal to 1.2 to 1.5 million square feet of office absorption. So, that is your back of the envelope calculation, or you can say thumb rule that we can adopt to analyze the office absorption rate. And then interest rates. So, RBI repo rates changes the impact on both demand and supply sides. 100 BPS rate increases typically reduces the absorption by 8 to 12%. So, interest rate also is something which we can see, and because of that we can analyze. And we have to remember that these are the policy changes we are talking about. So, policy changes or policy actions can definitely lead to the shortening of cycle or prolonging of cycle. So, cycle depends on these actions a lot. Then we have real estate specific indicators. So, like we discussed the overall economy indicators, real estate will have indicators like supply pipeline metrics. So, construction permits and approvals, where they are standing right now, under construction inventory, how much is there, developer fundraising and land acquisition activity, how well that is going on. So, these are your supply pipeline metrics which can tell you that how the developers, the builders, how they are looking at the current situation, or what is their strength right now, how much inventory is stacked up. So, all this something will tell you the supply pipeline metrics. Then we have demand indicators. So, net absorption rates and trends, they can inform you about the current demand that is playing out. So, net absorption rates and trends, they will tell you what is the direction of that. And then average time on market for vacant spaces. So, how long it is taking for vacancy to change into occupancy. So, that kind of thing will also be an indicator. Then site visit conversion rates and inquiry volumes. So, people who are visiting the site and then deciding to buy. So, if the conversion rate is going up, so it is a good indication. So, these kind of numbers and these kind of indicators can be looked for the cycle changing direction or not. Then we have rental rate movement. So, the rental growth, what is the current rental growth, or whether it is accelerating or decelerating, that we can see. Then concession package trends. So, where is the concession package, what is the concession package currently, or if there is a concession package or not. So, these kind of things can tell you the rental rate movement. And then lease renewable spreads, that is before and after a particular period of lease got over, and the tenant has renewed their lease, what has been the increase, has there been an increase in the lease or not. So, that kind of things can tell you that where the market cycle is heading. Then we have the investment market indicator. So, we have seen the overall economy indicators, we have seen the indicators of real estate specific indicators, and then we talk about the investment market indicators. So, here we have capital market signals, transaction volume trends. So, 25% plus year on year increase often signals early expansion, right. Then sharp volume decline precedes price correction. So, these are the volume trends which are telling you. Okay. Then we have cap rate movement. So, compression indicators in increasing investor confidence, right. So, compression of cap rates indicates increase investor confidence. We know that lower cap rates basically shows good sign, show a sign of confidence. So, compression indicates increasing investor confidence. Expansion on the other hand signals growing risk perception. So, this is something from cap rate which you can analyze. Then we have foreign investment flows. So, FDI increase often precede market expansion by 6 to 12 months, right. So, after expansion takes place, you can say that after FDI have increased their presence, after 6 to 12 months, you will see the expansion in the market. And withdrawal signals potential market peak. So, after they have started withdrawing, you will see that in 6 to 12 months, you will start seeing the weakening signs. So, foreign investment flows can be your leading indicators. So, these are some leading indicators in your investment market that can tell you the direction of real estate market. Then we have composite indicator framework. So we can see that we have real estate stress index components, we have index interpretation for Indian markets, right? And we have different phases. We can see that what are the ratios. So this way we can analyze. So let's see. So rather than relying on this single indicator, successful investors develop integrated monitoring approaches. So we have real estate stress index components that may include vacancy rates relative to historical equilibrium, rent growth relative to inflation, months of inventory supply, credit availability and terms, and transaction volume trends. Then we have index interpretation for Indian markets, right? So provide a quantitative threshold. So below 40 is your recovery phase, 40 to 60 is your expansion phase, hyper supply risk 60 to 80, and 80 indicates recessional conditions, right? So that is there. Then implementation requires quarterly assessment with market specific calibration. Each market has a different equilibrium level and volatility patterns. So the value of composite indicators is reducing false signal. Single indication can be misleading, but multiple indicators moving in the same direction provides more reliable signal. This systematic approach helps remove emotion from cycle analysis and provides objective framework for strategic decision making. Then we have cyclical sensitivity ranking. So different property types exhibit varying degree of cyclical sensitivity, which has important implication for portfolio construction and risk management. So hospitality, we have discussed this in earlier class also, that hospitality shows extreme sensitivity to economic conditions, and there can be immediate downturns and immediate rises in hospitality. So that is, very fluctuating nature of hospitality, very volatile. Then we have luxury residential. There is high correlation with wealth effect here in this particular segment. So high net worth individual adjust real estate consumption based on portfolio values and economic confidence, and retail depends on consumer spending patterns, which fluctuates with economic cycles. Experience oriented retail shows more resilience than traditional format. So this has more resilience because many of these buyings are being done for the actual living and not for investment only purposes. And then we have office spaces, your employment growth driven. We have industrial logistic, moderate cyclical impact, and then affordable housing. You have structural demand, support from demographics and government programs making it less cyclical. And then we have data center, which is technology driven and least cyclically sensitive due to secular growth trends, right? So portfolio diversification across property types can moderate over cycle impact. Understanding these sensitivity differences help optimize risk adjusted returns. Then we go to office market cycle characteristics. So here we can see cycle drivers. What are the cycle drivers here? So employment growth in office using sectors. So we have seen that how IT ITS sector is directly linked to the Bengaluru office market. specifically the grade A offices, they are directly impacted by this particular sector's growth. So, employment growth in office using sectors, then space per employee trends and workspace evolution. So, as we have seen one figure that the number of employees which are being hired by these companies is directly impacting the space requirements. So, space per employee trends and workplace evolution also goes up, and then infrastructure development affecting the sub-market accessibility, that can also be seen here. Then we have Indian market specifics. So, we have IT/ITES sector, dominance in Bengaluru, Hyderabad and Pune. Then financial services concentrating in Mumbai, Delhi NCR, and global captive center expansion trends is catching up in all the top cities of India. So, these are some Indian market specifics, and also we can see that definitely there is a direct linkage between employment growth and office using sectors. And current trend, hybrid work model stabilizing at 2 to 3 days per week in office, supporting continued but moderate demand growth. So, there has been an impact, but the impact has not completely, the office need has not completely go down, but because of the hybridization approach which is there for office goers, that at least 2 to 3 days per week they are going to office, and that is why the requirement of office is still there. So, we have residential market cycle variation. Now, in residential market, housing sector by price segment. So, luxury segment is greater than 2 crores, mid market is 50 lakhs to 2 crores, affordable housing is less than 50 lakhs. So, these are the different categories here. So, highest volatility is in luxury segments, and equity market correlation is very much there, because a lot of wealth is going directly into this segment. So, that is why it is highly correlated with equity market performance also, typically leads broader market in both directions. So, when it is going up or down, it is leading the both markets. Then we have mid market, we have moderate volatility, income growth driven, and follow the luxury segment with 6 to 12 months lag. So, first we will have luxury segment moving in a particular direction, it will be followed by mid market, and that is how the the way trend will happen. And then we have affordable housing, where with the lowest volatility, structural demand support, because of the government there is a support also, and the structural demand is always there, and government programs are influencing this significantly. So, basically this has its own system which is there apart from your mid market and luxury segment. Then we go to retail and logistics sector. Here we can see that there is a distinct cycle pattern. So, retail real estate, high location, specificity in cycle behavior, experience oriented retail showing more resilience, e-commerce impact creating structural headwinds for traditional format. So, first high location specificity in cyclical behavior, that is how location is very important. Then we have this that prime locations in major cities show different patterns than secondary market. Experience oriented retail demonstrates more resilience than traditional formats. Then e-commerce impacts create structural headwinds for traditional retail formats, but also create opportunities for last mile delivery and fulfillment centers. So, that is there for your e-commerce, their impact. And then we have industrial and logistic. Here you can see that industrial logistics shows lower cyclical volatility than office or retail e-commerce growth, provides counter cyclical support during economic downturn. Supply chain reorganization drives structural demand in this particular sector. So, current status shows both sectors in expansion phase, but with different underlying drivers and risk profiles. Retail faces ongoing structural challenges while logistic benefits from secular trends. Then we have cycle aligned investment strategies. So, here in this particular you will see that strategic approach by phase. So, in recovery phase, focus on opportunistic acquisition at distressed pricing, value add strategies through repositioning, conservative leverage with flexible financing. So, focus on during recovery phase, focus on opportunistic acquisition at distressed pricing, because that is the only time you will get that. Value add strategies through repositioning, and then conservative leverage with flexible financing. Then we have expansion phase. Development projects become viable. Core plus acquisition, close core plus acquisition with mark to market opportunities, because the leases are about to end and the new leases which will be formed will be at very higher rate. So, mark to market will be done at the market rate which are much higher than when they were signed. So, these kind of expansionary phase, if your lease is expiring during this period, it can be very, very beneficial. And then optimize leverage for the enhanced return. So, this can also be there, that you can optimize the leverage for enhanced return in this period. Then comes the hyper supply phase, where you will have to strategically, you have to be very, walking on a thin line here. So, basically selective development in supply constraint areas, right? It will be very, very selective. And then defensive acquisition with the long term leases, right? And capital recycling and risk reduction will be the aim. Then in recession phase, capital preservation priority will be there. Then selective opportunistic investments with patient capital, right? And then the focus on tenant retention and liquidity management during the recession phase. Then comes the leverage strategies across cycle. So, in recovery phase, moderate LTV 55 to 65%, focus on term and flexibility over pricing, and long term fixed rate preferred. So, during this period, try to go for moderate LTV, focus on terms and flexibility over pricing, and longer term fixed rate should be preferred. Then in expansion phase, strategic leverage increases to 60 to 70%, balance optimization with safety margin, right? So, that can be there. And then partial interest rate hedging can be done during this period. And then we have the hyper supply phase. In this, leverage reduction to 50 to 60% of LTV, extend maturities beyond cycle trough, right? And so, these will be there, and fixed rate instruments preferred in this particular period. Okay. And after that, we come to recession phase, where the leverage has to be reduced further to 40 to 55% LTV. Maximum flexibility is prioritized here, and then the relationship lender focus should be there, because during these turbulent times, if you have a proper relationship with lender, you can actually save yourself. So, this is the kind of leverage strategies across cycle. Then optimal exit timing. So, value maximization through cycle awareness. Here, best exit window would be what we are looking. So, best exit window include late expansion phase, when pricing reaches maximum levels before potential supply pressure builds. Early recovery can also be optimal to capture repositioning value while benefiting from cap rate compressions. Suboptimal exit periods include hyper supply phase when values may be peaking out, but supply pressure is building. Recession phase typically forces sales at significant discount. Then we have strategic approach. So plan, basically strategic approach here would be involving planning exit timing during acquisition, monitor leading indicators for optimal windows, maintain operational flexibility for timing adjustments. And the example here, Bengaluru office investors who exited during 2018-19 achieved 15 to 20% higher valuation than those waiting until 2020-21. We understand that because of the COVID period, it happened, and so that timing, how the exit actually took place, that was very, very important. Then we have risk management evolution. So in this, we have recovery phase risk, so timing risk and premature market entry, right? So execution risk in repositioning strategies can be significant. Migration involves phased deployment and conservative underwriting in this period. Then we have expansion phase risk. In this, shifts towards price risk from competitive markets. Development and interest rate risk increases, including disciplined valuation and hedging strategies will be your mitigation strategies. And then hyper supply or recession risk. This time tenant default and refinancing will be challenging. Liquidity and covenant breach risk will be there. There will be possibility of liquidity and covenant breach risk. And mitigation during this period will be enhanced reserves, proactive lender communication. So that is how you can sail through these difficult times. Then you have Bengaluru cycle analysis, which can help us understand the different stages. So positioning assessment made right now in year 2025, office market first, late expansion, early hyper supply, vacancy 8 to 9% with some market variation, right? Supply pipeline 12 to 15 million square feet versus 9 to 11 million absorption. Rental growth moderating to 5 to 7% from peak 10 to 12%. And coming to residential market, mid expansion. So we have strong absorption with 12 to 15% price appreciation. Inventory healthy 12 to 15 months versus 24 to 30 in 2020. Supply response increasing but still below demand. So in office, we have late expansion, early hyper supply. Residential, there is a mid expansion. So residential market is still in the expansionary stage, while office is in either early hyper supply or late expansion stages. And we are getting this analysis through the data which we have, whether vacancy, what is the vacancy there, and the supply pipeline versus the absorption, and the rental growth which is there, how it is performing. So these indicators can tell you that office market is right now in late expansionary or early hyper supply stage, while residential strong absorption and inventory stays which is healthy, and supply response is showing that there is still mid expansion stage in residential market in Bengaluru. So what are the investment implications? So selective office acquisitions focusing on grade A assets, right? Right now if you want to go into office, selective office acquisition focusing on grade A assets can be done. Then continued residential development opportunity, residents, you can still continue residential development it is still available, and actually it should be done because you are in the expansionary stage. And then monetary supply pipeline for transition timing, you can actually look into that also in for implication, investor implications. So that is how you can look at the business Bengaluru business cycle. Then we go to forecast. So office market office, we see transition to hyper supply by the quarter 2025. We see vacancy increasing to 12 to 14% by mid 2026, and rental growth flattening to 0 to 3% annually. Residential market, we can see continued expansion through 2026, price growth moderating to 6 to 8% by 2027. So that is far away, and potential oversupply in peripheral areas by late 2026. Strategic recommendation, implement defensive strategies for office investments, maintain disciplined approach to residential development, and prepare for cycle transition over 18 to 24 months. So, the conclusion and the key takeaways here: cycle inevitability, real estate market consistently experience cyclical patterns due to inherent market characteristics. Phase recognition is important, so understanding current cycle position is crucial for optimal investment timing. Leading indicators, proactive monitoring of early warning signals provide competitive advantages, and property type variations or different sector move through cycles at different speeds and intensities. So you have to understand this, and we have seen in just before example in Bengaluru that in office market and in the residential market there is a divergence. In Bengaluru market we can see and we can predict that there is a chance of hyper supply in the cycle in office segment, while in the residential segment it is still in the expansionary stage, and development projects can still take place in that segment, and that is how property type variation can actually differentiate in that way also. So strategic adaptation, investment approaches must evolve with cycle phases to optimize risk adjusted return. So your approach of investment must evolve with cycle phases to optimize the risk adjusted return. So keeping an eye on the cycle, real estate cycle, is very important, because that can influence your overall profitability of the venture you have taken. So with this we are concluding this particular segment. Hopefully you have understood all the concepts of real estate cycle. These are some practical applications. So for investors, develop cycle monitoring frameworks, adjust capital allocation, and for developers, time project launches with demand cycles, and adjust supply line based on the absorption projection. So planned process can actually help you in gauging what is the current situation of cycle and what it will be after a particular time period. You can read reports, or you can create your own frameworks to come to that conclusion and take the decisions. And so for occupiers, optimize lease timing based on rental cycle projections, and plan space requirement considering the market transition. So these are some practical applications of what we have learned today about the real estate market cycles. So we can go for certain questions for reflection also, so that you can understand the implications of the real estate cycles. When you think about it, when you will try to answer these questions, you will be able to better reflect on what we have learned. So how might increasing institutionalization effect affect future Indian real estate cycle patterns? How can investor balance cycle timing with fundamental asset quality in investment decisions? Or how do regulatory changes influence cycle duration and amplitude in Indian market? So answering these questions, you will be able to better understand this particular area, which is very important when it comes to investment decisions in real estate market. Thank you so much.